I've taught this before, but as a reminder, what you're seeing is when there's a swing high that forms, if there's a fair value gap on the left side of it or on the buy side of the curve, and before it rolls over and starts to go down the other side, I'm going to go with this side over the right side. Meaning you can see there's two of them. There's a small, let me elongate the chart a little bit. I want you to understand what I'm saying here. When we're looking at a volume imbalance like this, and we're in a swing high, I'm going to use this candlestick's wicks high and that volume imbalance high, and I'm going to call that a fair value gap. Another PD array. I'm just throwing them out here this year, aren't I? So it's going to act as an inversion fair value gap. Why? Because it's part of the buy side of the curve before the market rotates and goes lower, as I indicated it would last night. Okay. So not only did you have a bias last night, I told you it was going to drop. I'm not interested in going long. And we're going to see a contrast between when do I like the fair value gap on the right side of a swing high, which is your model 2022, or if, like I taught last night, a turtle soup false breakout. So you got to find a short-term high, then another short-term high higher than that, and then it rejects that higher breakout and then pulls back into the range. We do not need it to be a complete reversal. We just need it to give that characteristic. And the first presented fair value gap after that, that is the one you want to carry forward. Now, in a fractal sense, okay, like a small pattern that can be amplified in infinitude, in the higher time frames or reduced down to the smaller time frames, it's essentially model 2022. It's the cookie cutter that I taught you in model 2022. Okay. But I didn't teach you in the model 2022 model to keep that fair value gap and extend it in the future. That is what I revealed last night. That is that little tiny piece of information that's just like, wow, that's really good. And you don't appreciate it when I said it last night until you go back and start looking at your charts and collecting the information. It's like, oh my goodness, there it is. Yes, Virginia. Consistency is within reach. So when there is a fair value gap on the right-hand side, and that would look like this. Let me show you real quick by contrast, because I don't want this video to be too long. We had the volume imbalance down here. That candlestick's close. This candlestick's open. So that separation between the two bodies, that's my volume imbalance. And then the candlestick's high up here. So that would be a standard. I got to highlight it, don't I? I'm so nervous talking to you guys live. I might say something wrong, and I can't edit it. I'm really not nervous. But the gap here, normally you could see this. It's working too. But I'm personally, me, Michael, I'm going to be looking for the inefficiency, if it exists, on the buy side of the curve. That one is going to be much more sensitive and more precise, in my opinion, than that of the fair value gap that's over here, because they can wick through this, kind of like what you saw intraday when I was taking my short. And you can watch that video on the X channel that I host on Twitter, now X. The buy side of the curve, any inefficiency that I have on the left side, I'm going to use that one over and choose that one over and above any fair value gap over here on the right-hand side. Now, here's the problem. This is what's going to be the downside to this. I may not get my fill because there may be a smaller fair value gap that's lower than this one would be. And it might just use that and never get up to the one I'm aiming for, and my limit order never gets filled, or my market execution never gets the opportunity to be presented to the marketplace and get a fill. So that's the one caveat. I mean, barring just simply being wrong and the market just goes right on through, and that's always the case. I mean, you have a chance of always have a losing trade, but in the grand scheme of things, I'm going to side with any inefficiency on the buy side of a curve of a swing high if it's there. Okay, so now I've taught you two more PD arrays, two different approaches to using things I've already taught, but it's a small little twist in how you can use the information and how it's useful. So no, I'm not interested in this fair value gap. but you can see how we went up into that and notice that it failed to get to consequent encroachment. See that? Let me zoom in a little bit. Just fell short of it. Is that strength? Not at all. It's saying, I can't get there. So by having this on your chart, okay, and then understanding that we are likely to work inside this range, that daily buy side imbalance, sell side efficiency that has two volume imbalances on it, which makes it a what? Suspension block.